Welcome to the deep dive. Today, we're tackling a question that's probably on a lot of minds. Can we actually predict where the stock market is going?
hmm
More specifically, we're going to dig into this really fascinating research paper you shared with us. It's called S&P 500 Trend Prediction by Shasha Yu, Qinshan Zhang, and Yue Zhao.
That's the one. And, what I think makes this paper particularly interesting is its approach.
How so?
Well, it kind of moves beyond the usual analysis methods and really dives into machine learning to
Yeah.
see if algorithms can, give us an edge in forecasting S&P 500 trends.
Okay, right. Let's unpack this then. Our goal here, our mission for this deep dive is pretty clear.
hmm
We want to understand which machine learning models these researchers found were, well, most effective.
Right, for predicting upward movement in the S&P 500.
Exactly, both short-term and long-term. We want to pull out the key insights, the implications, without getting totally bogged down in like super dense technical stuff.
Makes sense.
So where did they even begin this investigation? What was the starting point?
Okay, so their work is actually built on a methodology called the 101 Formulaic Alphas. This was introduced by Kaku Shadzi back in 2016.
Formulaic alphas. What are those exactly?
Well, think of them as mathematical expressions. They're specifically designed to try and capture the sort of underlying forces driving the market.
Okay, so not just random math.
No, not at all.
Yeah.
They're supposed to represent key market dynamics. For instance, some look at momentum.
Like prices going up tend to keep going up.
Exactly, or falling. Prices keep falling. Others focus on mean reversion, this idea that prices eventually drift back towards their average.
Right.
And there are also alphas that look at trading volume data, other statistical things. So these one-on-one formulas, they basically provided the building blocks, the features for the machine learning models to chew on.
Got it. So they use these formulas to generate features. Where did they get the actual market data to plug into them?
They used historical data from Yahoo Finance, pretty standard source.
Okay.
And it covered a pretty decent period, November 1st, 2013, all the way to October 31st, 2024.
Wow. Okay.
And this data included daily updates for the S&P 500 index, plus all 500 stocks within it. So, the daily open, high, low, close prices, volume, adjusted close, the usual stuff.
That is a ton of information. I'm guessing they didn't just use every single piece of it from day one.
No, you're right. They made a conscious choice to exclude the first 16 months of data.
Why was that?
Well, partly it was because of how some of those alpha calculations work. They involve looking back over a set period, these things called rolling window calculations.
Ah, so you need enough past data to make the calculation meaningful. Like a moving average needs history.
Precisely.
Yeah.
You need that window of past data. Plus, apparently there was some patchy data in those early months anyway, so cutting that period out just ensured they had a more solid, reliable foundation for the analysis.
That makes sense. Garbage in, garbage out, right? You need a clean base.
Exactly.
So what did they do to get this data ready for the machine learning models? Any cleaning or prep work?
Oh yeah, several key pre-processing steps. First, they tackled missing data. They used forward filling, which just means if a value is missing, you fill it with the last known value. Simple enough.
Okay.
They also left out the very last day of data. This was to account for the lag that's inherent in any predictive model,
Yeah.
You're always using the past to predict the future.
Right. You can't predict today using today's closing price.
Exactly. And finally, they standardized all the features. This is pretty important. It puts all the different data points onto a comparable scale.
So one variable with big numbers doesn't dominate the model just because it's big.
Precisely. It prevents that kind of bias.
Okay, so they've got this nice, clean, standardized data set. Now, how did they actually use those 101 formulaic alphas? Did they just feed all 101 into the models?
No, not quite. That would probably just add a lot of noise.
Yeah,
Right?
likely.
So they went through a process of feature engineering and, importantly, feature selection. First, they split the alphas into two groups, discrete ones with less than 10 unique values and continuous. Then for the continuous ones, they got rid of any feature that didn't show much variation over time. Specifically, if more than 20% of its values were identical, it was out.
To make sure the signals actually changed with the market.
Right. They wanted signals that fluctuated, and they also dealt with multicollinearity. That's when features are highly correlated with each other, which can kind of confuse the models.
So if two features basically tell the same story, you maybe only need one.
Pretty much. They removed features that had a correlation of 0.99 or higher, super high correlation. After all that, they narrowed it down from 101 to a set of 40 alphas for the main analysis.
40 still sounds like quite a few, but definitely better than 101. So let's get at the predictions. How did they use these 40 alphas to try and see if the S&P 500 would go up?
Right, so they focused on two different kinds of upward trends, short-term and long-term.
Right.
For the short-term predictions, they defined an upward trend simply as, did the percentage change in the typical price, that's just the average of the high, low, and close for the day, go up by more than 0.1%?
Just a small nudge upwards.
Yeah, they saw it as like an early warning sign, a potential early indicator of an upward move.
All right, so for these short-term signals, they tested a bunch of different machine learning models, didn't they? What came out of that?
They did. They looked at logistic regression, decision trees, random forests, k-nearest neighbors, KNN, and XGBoost. Quite a lineup.
Okay, walk us through it. How did they perform?
Sure. So logistic regression was sort of balanced overall, but maybe slightly better at spotting when an upward trend didn't happen. Its accuracy was around 61, 62%.
Okay, moderate.
The decision tree also showed moderate performance, but there were signs of overfitting. It did better on the data. It trained on like 68% accuracy, but dropped to 59% on new test data.
Overfitting where it learns the training data too well but can't generalize.
Exactly that. It also struggled a bit more with actually predicting the upward trends correctly. Lower recall for those.
Gotcha. What about random forest? That's often quite powerful.
It was strong on the training data, yeah, like 71% accuracy. But again, some issues generalizing testing accuracy fell to 62%. Still, it was relatively better than the others at actually detecting those upward trends.
Interesting.
And their analysis actually pointed to specific alphas, alpha 054 and alpha 053, as being particularly important for the random forest model. They even found that using a smaller group of just 24 key features could work well.
So yeah, some alphas clearly matter more than others. That makes sense. How did KNN and XGBoost fare in the short term?
For KNN, they tuned it by trying different numbers of neighbors, the K. They got a testing accuracy around 61%. Performance was sort of balanced, but precision and recall were just moderate.
Okay.
It was a bit better at identifying when there wasn't an upward trend, but less good at catching the ones that did happen.
And XGBoost?
XGBoost showed high training accuracy, but again, only moderate testing accuracy, around 59%. So that also suggests some overfitting might be happening. It was also slightly better at spotting the absence of an upward trend.
Okay, that's a lot of models and results. What was the main takeaway here? For these short-term, early alert type predictions, did one model really stand out?
Yes, and this is where it gets quite interesting. The researchers actually concluded that KNN was the most effective model specifically for these short-term predictions.
Really? KNN?
Yeah. They found it was pretty reliable for giving those early signals, those heads-ups about potential upward moves. And crucially, they think its success was largely down to those momentum-based indicators within the formulaic alphas.
So KNN was good at picking up on immediate momentum shifts.
It seems so. It appeared particularly adept at catching those quick, maybe day-to-day directional changes. So yeah, if you're trying to spot those very near-term upward movements, this research suggests focusing on models good at capturing that immediate momentum. And KNN seemed to fit the bill here.
That's a really key insight. KNN plus momentum indicators for the short-term signals. Okay, let's switch tracks then. What about the longer term? How did they even define a long-term upward trend?
Right, for the long-term view, they used a tougher criterion. They looked at the percentage change in returns over the previous 60 days.
Okay, a longer window.
Yeah, 60 trading days. And they only called it an upward trend if that change was bigger than the 75th percentile of all the returns in that past 60-day period.
So a relatively strong, sustained move upwards compared to recent history.
Exactly. The idea was to capture more significant, sustained movements, not just little blips. And they tested the same set of models again.
And what did they find on that longer horizon? Which model worked best there?
Okay, so when looking at the overall performance for long-term forecasting, XGBoost actually came out on top.
Interesting. After it showed some overfitting signs, short term.
Yeah. For the long term, it achieved the highest accuracy, around 72%, and seemed to have the best balance between catching true upward trends and avoiding false alarms. That was reflected in its AUC score, which was the best at 0.64.
How did the others compare long term?
Well, logistic regression was moderate, but had decent recall, meaning it was reasonably good at finding the actual upward trends when they happened. KNN, interestingly, had high recall. It caught a lot of the upward trends, but its precision was low.
Meaning it flagged trends that weren't really there more often. Lots of false positives.
Exactly, more false positives. Decision tree and random forest had okay accuracy, but kind of struggled with recall and AUC for the long term. And the neural network was balanced, but its overall metrics weren't as good as XGBoost.
So XGBoost wins for the long haul. What changed? What made it more effective over that longer time frame, especially given the earlier overfitting hints?
That's a really important point. One absolutely critical thing they did for the long-term models was tackling class imbalance.
Class imbalance.
Yeah, in their data, there were just, well, more periods of downward trends than strong upward trends, especially by that stricter long-term definition.
Ah,
And that imbalance can bias a model. It might just learn to predict the more common outcome downward trends most of the time.
right, because that gets it right more often overall, even if it misses the important signals.
Precisely. So to fix this, they used a technique called SEM-OATIMIDI,
Yeah.
synthetic minority oversampling technique. It basically creates artificial examples of the less common class, the upward trends, to balance out the data set.
So it gives the model more examples of upward trends to learn from.
Essentially, yes. And they found that doing this, rebalancing the data, significantly boosted the precision and recall for the long-term models, especially helping XGBoost.
That makes a big difference.
It really does. They also noted that the most important alphas for predicting these long-term trends tended to be different from the short-term ones.
Oh, how so?
For the long term, the key alphas seem to focus more on things like weighted price positions and, significantly, trading volumes of stocks that were already showing big price moves and had high trading activity.
So long-term prediction relies less on just pure momentum and more on price action combined with, like, market conviction shown by volume.
That seems to be the implication, yeah. It suggests that for sustained moves, you need not just direction, but also significant participation reflected in volume.
That's a really valuable distinction they drew out. Different drivers for different time frames.
Absolutely.
Yeah.
It really underscores how market dynamics can shift depending on whether you're looking hours ahead or months ahead.
Okay, so let's try and pull this together. The big picture seems to be, for those quick short-term alerts, KNN using momentum indicators looked most promising in their study.
Right.
And for forecasting the more sustained, longer-term trends, XGBoost showed the most potential, especially after they dealt with the data imbalance using SESMOT and focused on those price and volume factors.
It captures it well, yeah.
What about the other models, then? Did they just not really measure up in this particular study?
In this context, they seem to have more limitations. Logistic regression and the neural network, while okay, just weren't quite as good at picking up the finer signals, maybe.
And the tree-based ones?
Decision trees and random forests, while they can be powerful, seemed quite sensitive to getting their settings, the hyperparameters, exactly right. If those weren't perfectly tuned, performance suffered. And we saw the overfitting issues too.
Right. It definitely sounds like applying machine learning here isn't some magic bullet.
Yeah,
It's complex.
for sure.
Did the researchers themselves highlight limitations or areas where more work is needed?
Oh, absolutely. They were quite upfront about it. They acknowledged that overall the recall and precision, particularly for the long-term forecasts, still had definite room for improvement.
Okay.
And as we talked about, some models did show those signs of overfitting. They also suggested some really interesting paths for future research.
Like what?
Well, one idea was to explore more advanced neural network types, specifically LSTM's long short-term memory networks.
Ah, those are often used for time series data, aren't they?
Exactly. They're designed to handle sequences, which makes them potentially very suitable for stock price data. They also suggested looking into even more sophisticated ways to handle that class imbalance issue, maybe beyond SEM-OATIMIDI.
Okay.
And finally, a really practical idea, applying this whole framework not just to the S&P 500 index, but down to the individual company level.
Which could give much more specific insights for actual stock picking, potentially.
Potentially, yes.
Yep.
Much more granular results.
Those all sound like very sensible next steps. Okay, so wrapping it all up. This research suggests machine learning, particularly KNN for short-term momentum signals, and XGBoost for longer trends driven by price and volume, can be useful tools in trying to predict S&P 500 direction.
I think that's a fair takeaway.
Mm-hmm.
But, it's crucial to remember, and the researchers would surely stress this, predicting the market is incredibly hard.
Always the caveat.
Always. So while these models show promise, and they give us valuable insights into which techniques might work better than others, they are definitely not crystal balls, not infallible predictors.
Understood. So as you, the listener, process all this, maybe consider this. How do these findings, this distinction between short-term momentum versus longer-term volume and price conviction, how does that align with or maybe challenge your own ideas about how markets work or even your own investment approach? And what other questions does this deep dive raise for you about using machine learning in finance? It's certainly a fast-moving field. Thanks for taking this deep dive with us.